So now we look at what is a provision, what is a contingent liability, what is a contingent assets. So what is a provision? A provision is a liability of uncertain timing or amount. Okay. See, normally we in our exams we would have seen like several types of provisions. For example, provision for depreciation, provision for provision for discount on debentures. Okay, provision for doubtful debtors. Okay, provision for bad debts. Okay, so or provision for a discount on debtors. Okay, we have like so much provisions we have. Okay, but the key element is we cannot create a provision as per our will. Okay, there is a definition for it. Only if it meets that definition we can create a provision. Okay, so provision is a liability, okay, of uncertain timing or amount. So what we don't know is we don't know when we are going to pay it. Okay, and we don't know what is the amount that we are going to pay it. Okay, that's why it is a provision. If you know both of these things, is it's actually a liability. It's actually a liability. To qualify for provision, all conditions are required. Number one, there should be a present obligation. Okay, for example, like warranty is a provision for warranty, or provision for guarantee is like accepted, because there is a sometimes companies give a legal notice saying that if you have a defect in the product you can return it. That is a legal. Constructive means they don't have any legal claim like that, but customers, what they do is whenever there's a problem in their product they simply return it. Okay, but there's no any uh, legal provision like that. Okay, even if there's no legal provision, it's called as constructive. Okay, so that's called as a present obligation. So the company has to pay money for some kind of a for some kind of a future expense. Probable transfer of economic benefit. So certain products will get damaged and we have to give warranty or guarantee amount for that. Reliable estimate of potential cost. Of course, we know what would be the kind of damage and what would be the cost for repairing that damage. So we know that. So as all these things are met, you can create a provision for warranty or provision for guarantee. You cannot create a provision for future loss. Okay, assume a CEO says, I want to create a provision for future loss. Can you create this? The answer is no. There is no present obligation at all. Okay, you are not bound to pay someone some money. Okay, your loss is your future loss. So first item itself is not tick marked. So you can't do it. So or else like some other, the company wants to create a provision. Okay, provision for employee salary. Okay, they want to create a provision for employee salary. So this year salary they have paid, for next year or the future years they want to create a provision for paying the salary. The answer is present obligation. The employee has not at all worked now. Okay, so how can we create a provision for that? Provision for future salary cannot be created because he has not at all worked. Okay, future is going to come in the next year only, so we can't create that. Or provision for employee compensation. Okay, for example, he might get into an accident and we have to pay for that. See, that is like, that can be taken as obligation because it's a constructive obligation, because it is the company's duty to take care of the employee. And if in a year out of 100 employee, one employee is like facing health issues because of the company, then then the company has to take care of him. Okay, so definitely in this 1 year one person will become ill, so for him we have to take the medical expenses. So there is a present obligation. Okay, will he fall ill? That we don't know, but he might fall ill. Okay, if he will fall ill, then it's a liability. He might fall ill, that becomes a provision. Probable transfer of economic benefit. Of course, when he falls ill we have to pay that. Estimate of it. So because of the company's, okay, because of working in the company, if he has some health problems, we know like what kind of health problems might occur in that company. Okay, because we know the previous track record, we know like what our competitors are like suffering. Okay, our competitors employees are suffering, we know. So definitely we can create a estimate. If the provision is to be paid within 12 months, it's a current liability you have to show. And if the provision is to be paid after 12 months, we can show it as a non-current liability. Okay, so that's about the concepts here. So we look at what is a contingent liability and asset. So in our Indian context, in our BCom MBA exams, we would have not heard these concepts at all, contingent liability and asset, but we will discuss here. A contingent liability is, there is a possible chance, okay, in provision there was a probable chance, but in contingent liability there's a possible chance. Here the chance of some activity is like much more lower. Okay, so a possible obligation that arises from the past event and whose existence will be confirmed only by the occurrence or the non-occurrence of one or more uncertain future events not wholly within the company's control. Okay, so here the chance of something occurring is like very less. Okay, but still we have to tell it to the shareholders. We have to tell there can be a liability. Okay, there can be a liability, a present obligation that arises from past events, but is not recognized because, okay, we do not show it as a provision. Why we do not show as a provision is, it is not probable. Okay, it is only possible that a transfer of economic benefit will be required to settle the obligation, or the amount of the obligation cannot be measured with sufficient reliability. Okay, so for example, uh, an employee has like fallen down in our company and has hurt himself. He has filed a case in the court saying that because of the negligence of the company I have fell down. And usually this kind of cases, okay, has does not have a probability, means like higher, something like more than 50%. Possible means it's like lower. Okay, so the possibility of him winning the case is like very low, something like 30% or something. In this case, we just show it as a contingent liability. Okay, because the shareholders should know that a case has been filed on the company and the company has a lower chances of losing this case. So that's about contingent liability. For example, if it's a very chemical factory and some chemical has fallen on that employee, okay, and he says it's because of the negligence this has occurred, okay, and he has again filed a case. See, normally in this kind of a case, the court is going to award the compensation to the employee. Okay, so there's high probability because the negligence is on the part of the company, so there's high probability. So in the first case where the employee has fallen down, it is just a contingent liability. In the second case where the chemical has fallen on the employee, that is has a higher chance of losing. Okay, company has a higher chance of losing, so it becomes a provision, right? So that's the difference between contingent asset and liability. Sorry, that's the difference between contingent liability and provision. Okay, so to qualify for contingent liability, it has to meet all the conditions. There should be a possible obligation, and we couldn't estimate the amount properly. So that's why we show it as a contingent liability. And the last one is a contingent asset. See, contingent asset is a possible sale. Okay, you cannot see, only actual sale can be entered in the books. Okay, you cannot create a provision for sale. Okay, see, provision for expense can be created. Okay, provision for discount on provision for bad debits can be created. Provision for sales cannot be created because that's the prudence concept. Okay, so you cannot do that. A possible asset that arises from past events and whose existence will be confirmed by the occurrence of one or more uncertain future events not wholly within the enterprise's control. For example, we'll reverse a case. See, the company has filed a case against a supplier, okay, for supplying some bad goods, and definitely we are going to win that case. Okay, we are going to win that case, and we are going to get a compensation. So that's going to be an income. So shall we create a provision for future income? The answer is no. We can't create a provision. What we could maximum do is we can just state in our accounts, we can just write it in our accounts without any numbers, saying that we are eligible to get a compensation of this much, okay, from the supplier. So that's what we could do. So we cannot like uh, proactively we can't like book sales. That's like impossible. That we can't do. So this is the concepts here. If something is like virtually certain, above 95%, okay, it's a provision. Above 51% itself, okay, it is still a provision. 5 to 50%, it's just a contingent liability, and below 5%, you just ignore it. In terms of an asset, if it's like over 95% of certainty is there, you can show it as an asset. If it has a probability of 51 to 95%, it is just a contingent asset, and anything below 50%, okay, below 50%, you have to ignore. Okay, there is no contingent asset in financial statements. It is either an asset or disclosure. So no provision at all you can create. So we'll see some examples so that you'll get a better clarity about this. First one, a company is engaged in legal dispute. The outcome is not yet known. A number of possibilities arise. Okay, so the company is in a legal dispute with someone. The outcome we don't know. Let's see the first one. It expects to pay about 1 lakh. So you know about the amount. You know the amount and you know that you are going to lose. In that case, it is a provision. Possible damages are 1 lakh, but it is not expected to have to pay them. Okay, so that's not a probability, that's only possible. Okay, the possible amount can be 1 lakh. So we don't know the estimate itself, we are like not sure. So we don't know the probability or we don't know the amount properly, it becomes a contingent liability. The company expects to have to pay damages but is unable to estimate the amount. So if you're not able to estimate the amount, it's contingent liability. The company expects to receive damages of 1 lakh and this is virtually certain. Okay, it's like 95% you know that it's going to be, we are going to get the compensation. It's an asset. The company expects to have a probable, okay, the probability is only there, receive damages of 1 lakh. It is a contingent asset only. The company thinks it may receive damages, but it is not probable. You don't need to show it at all. Okay, only when you are like probable, you can show it, like you can at least show it as a contingent asset. If it's below that, you don't need to even show that. Okay, so hope you got a clarity around provision, contingent liability, and contingent asset. Let's see about the question. During 2019, SMACO gives a guarantee of certain borrowings of Pony Co, whose financial conditions at that time is sound. Okay, so there is one company is giving a guarantee to the other. So if Pony fails, I think Smack has to pay it. But now there's no reason to pay it because Pony is like really good. During 2020, the financial condition of Pony deteriorates, and at 30 June 2020, Pony Co files for protection from its creditors. What accounting treatment is required? Okay, in 2019 and in 2020. In 2019, okay, it was like absolutely we don't need to give a provision. Okay, we don't even need to show contingent liability. Okay, so we don't even need to show it actually. Okay, it's like so remote. But in 2020, the things are like becoming very difficult. So we have to create a provision. Okay, we have to create a provision. So let's see the answer. Okay, so he says that we will better create a contingent liability in the first case. As we have given a guarantee, we will just create a contingent liability, and in the second instance, in the second 2020, we have to create a provision because he might fail to pay and we have to pay for it. So we'll start from this case. After a wedding in 2020, 10 people became seriously ill, possibly as a result of food poisoning from products sold by Caloco. Legal proceedings are started seeking damages from Caloco, but it disputes liability. up to the date of approval of the financial statements for the year to December 2020, Callow's lawyers advise that it is probable, okay, as it's probable, you have to create a provision that it will not be found liable. Okay, so the company doesn't need to, okay, it is probable that it will not be found liable. So you just need to show as a contingent liability you can show. However, when Callow lawyers prepare financial statements for the year ending 2021, its lawyers advise that owing to developments in the case, it is probable that it will be found liable. So in the first case, it is a contingent liability only. Okay, it was like possible. In the second case, it became probable. So contingent liability provision. It's the same thing as the last instance. So you have one more quiz. So this is a sum. A company has a provision for warranty claims. Brought forward is $50,000. It does a review and decides that the provision needed in future should be $45,000. What is the effect on the financial statements? Okay. See, earlier they already had 50,000 worth of provision. They want to reduce the provision. Okay. So the reduced provision is what has to be shown in the SOFP. So you have to show 45,000. So its answer is going to be either B or D. But as you have reduced the provision, okay, if you are increasing the provision, you should show it as an expense. But if you are decreasing the provision, you can show it as an income. So see, I think we should not like increase the expenses. That is that you do when you are trying to increase the provision. When you are decreasing the provision, your expenses decrease by 5,000. So answer should be D. Okay. Hopefully you got the idea.